Markets are praying for cuts. Trump wants a loyal dove in the chair, and inflation is stuck around 2.7%. Is the neutral Fed about to quietly reinflate a bubble or let growth run hot into an election year? Watch through to the end for real playbook for 2026, how to position across large caps, small caps, international and precious metals if the Fed only cuts 2 or 3 times instead of the deep easing the bond market once hoped for, and why be careful what you wish for applies when you beg the Fed to slash rates.
Remain on hold at this point before they cut rates further. And so that's why there's going to be so much interest around where is neutral, neutral being the level on interest rates that neither spurs nor slows economic growth. And many policymakers leading up to the policy meeting this Wednesday have said that policy is in a good place, essentially signaling, hey, we are good to hold here, take stock of the economy, and we have flexibility to move if the risks shift. Now, the other thing I'm going to be looking for is dissents, because over the past couple of meetings, we have seen dissents on both sides. This time, with the Fed expected to hold rates for the first time after cutting rates at 3 consecutive meetings, I expect Fed Governor Stephen Miron to dissent because he wants to continue cutting rates. I will be looking for Michelle Bowman to see if she dissents this time because she made a very clear-cut case on continued concerns about the job market to cut rates. This was in a speech 2 weeks ago. And then I'll also be looking at Fed Governor Chris Waller, who has also showed continued concern about the job market as well.
Jen, thanks very much. Appreciate it.
Dennis, it's great to see you here. So I was just checking what the bond market is predicting and not expecting a rate cut until the very end of July. That's a while out, but what's going to be in focus this meeting?
You know, with all the excitement around the Fed in the last couple of weeks, the Lisa Cook hearing and the Powell investigation,
yes,
and the speculation about the next chair, this could be a boring meeting. I don't think the committee certainly is not going to make any decisions about lowering rates, and I suspect they will simply talk about what they're picking up on the economy and leave it at that. So some of the communication, including the press conference, could really be minimal.
Well, let's talk about the odds of who's going to lead the Fed next, and also, will Jerome Powell possibly stay on at the Fed to kind of maintain a little bit of consistency, at least one more vote? How do you see this whole thing playing out? Is it one of the Kevins in the end? Is it who?
Well, apparently we're going to hear the nominee pretty shortly. At least that's a speculation that could come as soon as this week. And, I don't know how to read the thinking of the president on this. Given his agenda for much lower rates, I tend to believe that he will ultimately opt for someone he thinks is loyal and who will push his agenda in the committee. And I still believe Hassett is probably the most likely one to meet that criterion. But who knows? It could be last impressions, as has happened before.
Does Rick Rieder, who is now the front runner, at least in terms of betting market odds, and there's not a huge depth of liquidity in those markets anyway, but does he have a shot at this? Does he pass Senate confirmation? Doesn't have a whole lot of history with the Federal Reserve.
I think he has a shot at it because he's an expert on fixed income and the bond markets. And in some respects, because he's not an insider, may have some advantage. But at the end of the day, I think the president more likely is going to go with someone that he has had enough contact with to develop some trust that this person will be his emissary to the Fed. And I'm not sure Rick Rieder qualifies in that respect. They're all qualified candidates, so could be Rieder, but could very well be any of the other three.
Well, let's talk about the balance of risks here and the Fed's dual mandate, maximum employment, stable prices, meaning inflation, holding steady here. What do you see the risks in the market? Does the Fed have ammunition to potentially lower rates, even in July or later in the year? Or do you just think it's kind of done now?
Well, I don't think you can count on anything because the circumstances can change dramatically. But given the momentum of the economy coming into this year, and the relative stability of the employment markets, the stickiness of inflation of around 2.7%, depending on how you measure it, in my opinion, it's a perfect time to just wait a few meetings and see how things develop. And I'd add to that historically the first quarter is often thrown a curveball. Even last year, 2025, the first quarter was different than the other 3 quarters of the year, much weaker. So that suggests that you should be patient into the spring and even into the summer before you have a clear picture of how things are trending.
We got under a minute here, but we got time for one more. Anything we didn't cover? What's on your mind here that you'd like to tell the viewers?
Well, what was on my mind a week or so ago would have been Fed independence and all the risk associated with that. The winds have blown favorably in terms of Fed independence, at least in some respects. The Supreme Court hearings seem to suggest support for Lisa Cook staying in the job and some different treatment of the Fed. So I'm a little bit less concerned about that. The thing that would be on my mind is who's going to succeed Jay Powell, because I think that leadership is important to the whole world, not to say the United States. And we really want to have someone who will lead the committee with adequate independence.
I'm with you there. Thank you so much for your time here, Dennis.
Thank you so much, Jared.
I just want to touch on the potential for a shutdown, first of all. As we just heard from our Ben Worshkull, this one, unlike the one that we saw late last year, because it's a partial shutdown, but still, are you now starting to handicap a potential economic effect from that?
Yeah, so I think being partial, it makes a big difference. Obviously, there's still a lot of big agencies left to be funded, but the drag coming from kind of the economic calculation, the furlough of workers would be more modest than what we saw in the fourth quarter were this to occur. And I think, more importantly, from my seat where I am as an economist, what I'm most worried about is probably the data, because we're still recovering from some of this missing data. So not having the Bureau of Labor Statistics be able to publish employment data, inflation data, while they're still kind of catching up to the effects of the previous shutdown, well, I think that will cause more of a disruption, both to markets, but also for economists, for the Fed, for policymakers as well. So I think that's a big risk, and we'll have to see how things play out this week when it comes to the votes.
Stephen, I'm curious also, because I'm home in New Jersey today broadcasting because the Jersey Transit was not running today. I'm curious, when you see a big storm, the scope of which we haven't seen for quite some time, how much of an impact does that have on economic growth? Or is it something that's sort of just like it was with the shutdown, maybe a little bit delayed or displaced?
Well, that's a great question. And I'm in the office, as you can see today. So at least some of us have been able to make it in, but we're all kind of fighting the weather. I'm one of 4, I think, here in this office, so not many. And we actually were able to look at a previous storm in 2021 and see how that affected consumer spending, both our data and the official data. And you do see that these major storms can be a drag, and they tend to get made up in subsequent quarters because that spending is going to happen at some point or the other. But there is some loss activity, right? You're going to have some flights that are canceled that don't come back online. You'll have stores that are shut for the day, and maybe they're not making up that business, so to speak. So there is some loss of activity. It's relatively modest, I think, in terms of net loss, but you could see a drag in the first quarter and then maybe a boost in 2Q as you get kind of that mechanical rebound similar to the shutdown.
Gotcha. Only 4 people in the office. Wow. I guess you got a lot of commuters there at B of A also. Let's talk about the Federal Reserve meeting this week. We all are assuming there's not going to be any change to rates. So if that's the case, what are you really going to be focusing on here? Is it going to be sort of the political questions that Jay Powell is likely to get during the presser? Is it going to be dissent? What do you think?
Yeah, I think of the things, I mean, obviously, we're going to be parsing the statement as we always do. We'll be parsing the presser. I think you make a good point in saying that the presser is probably going to revolve around political questions and not necessarily forward guidance. So we won't get too much from that this time. But I do think dissents will matter because you're going to start to see, you know, how are things positioned on the committee heading into the post-Powell Fed, when we get a new Fed chair, and that could happen any week now. Obviously, we've seen betting markets move around about who people expect to be the next Fed chair. But we'll see with dissents, you know, is the committee still biased towards cutting? Is that still that firm camp? Obviously, Governor Myron is very likely to dissent. But then what about the hawks? You know, because there are several hawks on the committee who probably weren't too on board with cutting rates in December. And maybe they use this opportunity to maybe issue a dissent too. So I think you're looking at dissents, you're looking probably at the minutes in 3 weeks for really where the debate is, where the consensus is, how dispersed are the views on the committee. So we may not get that much information today, but maybe the dissents will give us some information. Maybe we'll learn more in 3 weeks from now when we get the minutes, though.
And as you mentioned, we might be getting an announcement of the next Fed chair this week. And, you know, the odds markets have just swung wildly with Rick Rieder now on top. He was somebody that a lot of people had sort of discounted entirely for much of this discussion. I mean, at this point, how important is it which of these individuals it's going to be? I mean, how, you know, is the outlook for rates going to move that much depending on who it is?
I think the short answer is probably not. You know, they're probably all supported of cutting rates more than maybe the current Fed led by Powell is, and cutting rates, you know, relatively quickly to say a 3% level. So you've heard that from Kevin Hassett, you've heard it from Kevin Warsh, you've heard it from Rick Rieder, even from Governor Waller, right, who's still kind of in the running. So I don't think in terms of the general dynamic, it doesn't change all that much in terms of direction of policy. Where you could see some differences emerge is maybe on reforming the Fed, on regulatory policy, on balance sheet policy, some more nuances. But I think the path for rates between the four of these candidates is not looking all that different. And then what I'll stress as well is they're just one vote. And, you know, the composition of the Fed may not change all that much other than getting a new Fed chair. So it's really going to depend on what the committee's read of the economic conditions is. And how do you get a majority view in terms of setting policy rates? And that's really going to always come down to economic fundamentals, economic activity, inflation, the labor market. So we'll have to see how things play out this year.
Mike, thanks for joining us here today. Let's start with the weather and talk about earnings since we got both of those going on here. I was just reading a B of A report. They expect U.S. GDP in the first quarter to take a hit of about 0.5 percentage point to 1.5 percentage points. How is that going to show up in stocks?
Yeah, well, stocks follow earnings. Earnings follow growth. So, you know, a hit in growth this quarter versus, you know, last quarter could definitely impair earnings a bit. But I would say the rate of growth is still above, you know, quarter to quarter of where, you know, expectations were certainly a couple years ago. And I think that stocks are looking through that. Certainly companies are looking through that. If you look at expectations for capital expenditures this year, they don't really show signs of slowing down. The growth rate may be slowing a bit, but the actual absolute dollars for expenditures there are expected to continue to be high. So we're, you know, it's good that we have a positive bounce here after a pretty weak early part of last week. And as you said, Jared, you know, finishing or looking to finish January in the positive. So we're fully invested. I think our conversations with clients have been, we want to be fully invested, but we don't want to be fully invested in one thing right now. And we expect U.S. large cap stocks to do well, but there are a lot of other things doing well right now as well.
Well, let's talk about those. So I'd be interested in what else besides U.S. large cap stocks and any industries, any sectors in particular in the large cap space that you like.
Yeah, so beyond large cap, pretty much, you know, broad-based other asset classes are doing well. Small cap stocks, which you mentioned at the top, have outperformed year to date pretty handily. A little bit weaker today, but it's had a heck of a run over the last couple of weeks.
Yes.
Precious metals, which you also mentioned, continue to do well as dollar continues to be, questionable to weaker. And international companies, partially because of that dollar trade, have started the year off pretty strong also. So in terms of like the risk asset kind of profile, or even within some of the precious metals, a safe haven profile, those investments have started the year strong. Within large cap, sectors beyond technology, there has been a broadening out. So if you just look at large cap, S&P 500, for example, another sub kind of different way to slice and dice that versus market cap weighted S&P, the equal weight index has done a few turns better than the broader base, market cap weighted S&P. And so if you broaden that out, that means, again, some of those companies are a little bit closer to mid cap, but other sectors, equally weighting those companies and getting a little bit more exposure to some of those sectors. Energy has done well, as you mentioned. Utilities have had a pretty decent start overall. So broad diversification. This doesn't mean the tech trade is over, but it does, we think, mean overall means a more solid and stable kind of jumping off point for the market in 26 if we have broader based participation across these other sectors.
Yes, and rotation is the lifeblood of a bull market, and we've finally seen some of that here. But within tech, software has really flagged this year. I'm just wondering, and a lot of that has to do with the AI trade, the thinking perhaps being that software is not going to be as valuable as it used to be. So what do you say to the investors who are in tech? Should they be focusing more on the chip space or something else?
Yeah, so for us, chips, hyperscalers, the value chain for us of AI is everything from a couple companies. Again, you mentioned at the top, you showed ASML, Taiwan Semi in terms of production. You've got the designers and the actual chip companies. Software has definitively lagged, the exception kind of being, over the last year and a half, being Microsoft because of its classification as an actual software, but also a hyperscaler. So there are opportunities there, but it has been a tough place. Even the things that had outperformed in software in 23, early 24, a lot of those companies had a really tough 25 comparatively. So there's some really good companies there. They look cheaper than they were a couple years ago, but we'd be fairly selective.
All right. I want to ask you about the Fed here. There's a lot of talk about Fed independence. We're actually going to be speaking with former Atlanta Fed President Dennis Lockhart later in the show about independence. But I want to ask you about rate cuts here. Do we need them this year, or can the market do without them? How many do you think are priced in? Just lay the land out for us on the interest rate cuts.
Yeah, we always take the position, that people say, like, don't, the mantra is don't fight the Fed. Sure. And we agree with that. But at the same time, we always kind of caution people, like, be aware, be aware of what it is you're asking for. If the Fed lowers rate, particularly significantly, which some seem to be calling for, when they do that historically, those are pretty scary times as an investor or just somebody working in the overall economy. So the measured approach, while they were certainly late to the game in terms of tamping down inflation in 22 and early 23, probably waited too long. A more measured approach, again, just like it is with stocks and earnings, Jared, right? Like if we let earnings of stocks kind of have a steady, a session or a couple quarters, and earnings are able to catch up with prices, and then we kind of, create a new base and go on from there, that's a healthy market. So if the Fed is seeing employment figures that they feel comfortable with, inflation still not where we know that they want it long term, but it's directionally, okay to stable, and they feel like they can wait to add more easing, then that's probably healthy for the overall market. In terms of what the market participants are pricing in, it should be, to me, no surprise to anyone that they're expecting pretty much zero cuts until June, which is when the next Fed chairperson will be in place, and then they're expecting a cut. And so if you look at what the market's pricing in, I think it's cut in June and maybe 2 more in the back half of the year. We would take, probably the under there, assuming nothing major happens with the market and the economy. And again, if it does and they're cutting, then that's not necessarily, the best case scenario for the economy or for markets.
No, if they have to catch down, that's not the greatest situation, but certainly not looking that way just yet. Mike, really appreciate your insights here. So thank you so much.